Well, you probably heard about how investing can make you money and many legendary stories online that talk about how much money people actually make. Well, as a beginner, how should we start to actually unravel the mystery of investing? So before we talk about what to do, we should look at why so many people actually lose money and fail in their investing journey. So first of all, there are many people I know they start off by investing in certain companies that they know or simply they like. However, beginners should understand one thing, that is picking stocks to invest is actually extremely hard for beginners. If you pick stocks, the following is at least what you need to do. First of all, understand financial statement. Second, understand market and microeconomic trends. Third, understand the company and the industry performance. While this might hurt you, but I still have to say, beginners may not conduct enough research and they don't do correct analysis before making investing decision. In fact, even though for very skillful and experienced investors, the valuation can still vary, or the market just simply does not meet the expectation of them. In case of very experienced investors, they know how to properly manage the risk, they know how to manage the portfolios and control the emotion. And this is lacked by the retail investors or the beginners as well. Next, we talk about emotional decision making. Many retail investors often react too emotionally to the market fluctuation, impacting their decision making. Especially for beginners, when you face the market volatility and you look at your account, look at the balance up and down every day, this will certainly terrify you. Next is wrongly enter into the zone of trading. Now, if you have no knowledge as a beginner, you might wrongly go into the zone of trading, which is completely different from investing. The trading activity will require very different knowledge, skills, and expertise from investing. First of all, you may fall into that quick profit allure because you gain experience of quick profit from watching your accounts goes up, which can be completely luck in the beginning. You decided to go into trading, and in fact, more than 95% of the traders lose money. And can you ask yourself that you are able to become the 5% as a beginners? Now, trading also requires a lot of time and expertise. Successful trading demands time, expertise, and also involve very high risk. For beginners who have very limited knowledge in trading, you're probably going to do many things wrongly, and you have no ideas about managing your risk. Besides that, if you do not have a systematic way to learn and improve your trading, it could actually destroy your life by first of all, making you emotionally unstable, and secondly, burn your account, which means you will lose all your money. So with all this understanding, how should a beginner actually start to investing? Now the solution is index investing. Basically, it means that you're investing in an index that represents the broad stock market overall, like S&P 500 or Nasdaq 100 or Dow Jones 30. An index is a portfolio of stocks that represent a particular market. For example, S&P 500 is the index that comprises all the 500 stocks that have the highest market capitalization listed in US. When we talk about index investing, we usually means investing in S&P 500. The benefit of index investing are really various. First of all, diversification. You probably always hear about big gurus saying that you don't have to put all your eggs in one basket, and that's emphasized by many big investors like Warren Buffett. But why? In stock market, we typically say that a stock have two types of risks associated to it. First of all, fund-specific risk, and secondly, the market risk. The fund-specific risk means that the microeconomic risk associated with the company itself, like the product, competition, and the fund's own operation. While the market risk means that the macroeconomic risk, like monetary policy or interest rate that linked it to the overall stock market. When you actually invested in an index, you are investing in a broad stock market, which means you are investing in many stocks. That will actually help you to eliminate the fund-specific risk, and this will significantly reduce the risk of your investment. Secondly, index investing gives you a passive investing style, which will allow you a better investing life balance, and you do not have to put in so much time and effort in doing analysis, conducting research like you do in active investing. Since you're passively holding the investment, you also incur lower costs compared to investing actively. Next, there's a proven track record with index investing. Index funds historically deliver very steady return over the long run. According to Investopedia, by the end of 2022, the average annualized return for investing in S&P 500 is actually around 10% since 1957, compared to investing in hedge funds. As a beginner, you do not really know how to evaluate the funds and whether the outperformance or the underperformance come from the fund is actually because of luck or the skills. So, in conclusion, investing is a long-term journey and it's not about timing the market but the time in the market. And in fact, many of my finance professors, they are also doing index investing. With that mentioned, before you actually get started, find a reputable broker, manage your risk, and grow your investing account. See you guys in the next video.